Till now, financial manager Mr. X had decided where to invest and from where the source of funds are required. A business makes money when it invests in a project. A portion of this earnings is retained by the business and portion is paid out to the shareholders. Profit after tax, distributed or retained. Distributed is dividend, retained is returned earnings. Paying dividends is crucial to attract and retain investors, boost shareholders' confidence, and the most important thing, that is to improve market liquidity. Therefore, dividend decisions are another important area to work upon for a financial manager. He must choose an optimum dividend policy. As per Gordon model, optimum DPR can be found out by considering relationship between IRR and cost of equity. Here is the table that shows company's growth, consistency and declining. The second column is condition of R versus cost of equity. Third is optimum dividend payout ratio. If in company's growth R is more than cost of equity, then optimum dividend payout ratio is 0. If it's constant, then R is equal to KE. There is no optimum ratio. If it's declining, where R is less than cost of equity, is 100% dividend payout ratio.
To expand, Mr. X should consider investment, financing, and dividend decisions that are long term finance function decisions. However, he must evaluate the short term finance function decisions that is generally related to working capital decisions to maintain sufficient cash flows, meet day to day operating expenses, and short term obligations. However, how can Mr. X find out that company is doing well in short run or not? So for this, Mr. X should see whether company has optimum working capital in the company. For this, we have current ratio and quick ratio, which is also known as asset test ratio. These two ratios are the best ratios and the best indicators of the working capital structure of a company. Have a look on the screen. The ideal current ratio is 2:1 and ideal quick ratio is 1:1. So these are the ratios to which a company can compare its working capital structure. Also, there are many more ratios which a company use for the various types of analysis. Comment down below if you want to see a separate video on the various ratios. This is how the financial manager, Mr. X of Biogreen Farms, took the decision regarding expansion of Biogreen Farms by considering long-term as well as short-term finance function decisions.